In part 2 of the doodad example, we're going to take you through adjusting entries, what they are, and then actually apply them in the case of doodad, and then from there make an adjusted trial balance, a multi-step income statement, simple one, and a classified balance sheet, again, a simple one. And then we will have walked you through the primary parts of the overall accounting cycle. It might be simple, simplified if you will, but still all of the key elements of the accounting cycle are right there. Let's get started. So last we left off, we had this trial balance. And the key thing here is to try to figure out, well, what does the trial balance tell us and what does it not tell us? First off, if it doesn't balance, something is definitely wrong. That doesn't happen very often anymore. We don't do things by hand anymore. We have computers that require every journal entry be balanced. As a result, when every journal entry is balanced, the computer adds up the debits and the credits. It's rare that the trial balance doesn't balance. But if it doesn't balance, clearly something's wrong. If it does balance, we can still have quite a few problems. Some of the errors that could be there, you could have debited an asset like WorldCom, where they debited prepaid rent for about $5 billion instead of rent expense. In other words, actually what they did was they just left the prepaid rent on the books when indeed it had expired, and they didn't adjust for that fact. They have equity effects, so we could debit a liability instead of owner's equity. We could have misclassification, which is really a minor, not as big of a problem. So one revenue over another, one expense over another, one asset over another instead of another. So those classification problems are not nearly as much of a problem as the income or equity effects that we talked about earlier. So we use this trial balance as a basis for preparing the financial statements, but we want to spend a little bit of time taking a look at it. So this is the trial balance that we have. We want to go down and just take a look at this and think about, well, okay, this $16,000 of prepaid insurance, that was some time ago when we bought that insurance policy. Maybe some of that's been used up. Or the prepaid rent. That was a while ago, I think at the beginning of March. Some of that may have been used up. And if so, showing it as an asset for $48,000 instead of what it should be, something less, is going to give users the wrong impression about the assets of this company. The equipment costs $36,000. We're not going to adjust that, but some of the equipment has been depreciated, and maybe we should show part of that as being used up as depreciation expense. On the note payable, down here, well, we have interest. It's accrued. That is, this interest is accumulated, but we haven't paid for it yet. We need to record that. So those are some of the examples of things that we need to talk about. There's also income taxes. We normally don't pay the income taxes until the beginning of the next quarter, but we need to accrue them. We need to show how much the expense would be and how much we owe, or at least our estimate for how much we owe. So let's talk about adjusting entries, what they are. The purpose of an adjusting entry is to bring the books up to date as of the last day of the accounting period. So we want to have this nice cutoff at the end of the accounting period so that all of the revenues and all of the expenses are recorded up until the last day, and none of the revenues and expenses from the next period are shown in this period. And we want to show our assets and liabilities, how much they should be at the balance sheet date, which is the last day of the fiscal period. So these entries are made by the accountant, typically in the back room. There is no real transaction with the outside world. Nothing really happened on this day. Still, some things have occurred, often a function of time. may not necessarily be a function of time, but have revenues been earned, expenses been used up that need to be recorded. These are never transactions with the outside world, and so cash, by definition, is either coming in or going out, and that's a transaction with the outside world. So adjusting entries never include cash, and these adjusting entries always have one income statement account and one balance sheet account. And if you find yourself doing two balance sheet accounts or two income statement accounts, it's probably not an adjusting entry. These entries are always dated. They're in the general journal, just like the first 9 journal entries that we did for doodad. But they're all dated on the last day of the accounting period. So they're made by the accountant, no real transaction with the outside world, never have any cash. They always have one income statement account, a revenue or expense, and one balance sheet account, an asset or a liability. And they're dated on the last day of the accounting period. So, how do we do these things? Well, let's do 4 easy steps. These are, you can call them Jeff's 4 easy steps if you want. I like to. Number 1, what account is being talked about? Number 2, use a debit or credit to get the needed balance in that account. Number 3, what is the sister account? And number 4, make debits equal credits with that sister account. All right, so let's take a look here. Does doodad need any adjustments at the end of March? Here, we've talked about it. We've got prepaid insurance, prepaid rent, we've got this equipment, we've got notes payable, we've got taxes. Yeah, there's some things there that maybe we should be adjusting for. For example, the equipment. We bought this equipment at the beginning of February, and it tells us right in the facts that it's going to last us 5 years, and we're going to use straight line depreciation and no salvage value. So we're going to use up all $36,000 over 5 years. So if we divide that by 5 and then again by 12, that'll give us $600 a month. And 2 months have gone by, so we multiply that by 2 and we get $1,200. And that is a reduction in the equipment and a reduction in owner's equity. But we don't actually hit equipment and owner's equity. What we use is depreciation expense and accumulated depreciation. Let's talk just a moment about accumulated depreciation. This is a contra asset account. It's linked to the equipment. You cannot get rid of the equipment without getting rid of that accumulated depreciation. They go hand in hand. So what we want to do is keep track of how much accumulated depreciation we've recorded. And so we have a credit balance. That's what we mean by contra. Normally, assets have debit balances. This has a contra or a credit balance. And so we're going to debit depreciation expense, which is a temporary owner's equity account. Owner's equity is increased with the credit. It's on the right-hand side. We're going to decrease it because an expense is some of our assets are used up, and we're going to record that expense. Debit depreciation expense and credit accumulated depreciation. In here, our explanation is to say part of the cost of this equipment has been used up. We're going to reduce the asset. We could credit equipment, no doubt, but it's better in the sense that we have better information about how much we have depreciated. So we keep track of that accumulated depreciation. And we've reduced our owner's equity for the expense. And we can now take that and post it, just like I did in the T accounts in the first part. We post it into the T accounts that we have before. We can take that and post it here and add to those T accounts. I think I'm going to skip that part right here. We'll assume that you know how to do that since you've done the first part. We're going to post to that set of T accounts this debit to depreciation expense. There isn't one yet. And a credit to accumulated depreciation. There isn't one of those yet. And then we're going to move on to the second one. The second one says we're going to record interest on the note. In order to record this interest, remember the note is a 2-year balloon note. That is, we're going to record interest for the period of time that we've actually owed it, and we are adding accumulating interest. And then we're going to we'll have interest expense, and we have a liability for that. So something I call the party formula comes up. So, and we use the party formula, which is principal times rate times time equals interest. And here we originally borrowed $26,000. The annual interest rate is 12%. And if it just says 12%, you assume that it's an annual rate unless they tell you otherwise. And that'll give us whatever 12% of 26,000 would be, the annual expense. And then what we really want to know is how much was the expense from February 1, or at the beginning of February, to the end of March. And that's in order to annualize this, in order to say, hey, all right, that's 12%, but there's only 2 12ths. We have to multiply it by 2 months have been out of a year, 2 out of 12. We have 520 of expense. And this is going to be shown as a reduction in owner's equity and an increase in the liability. We now owe that interest. And we're going to record this in an adjusting entry. We'll say, well, what account is being talked about? Well, that's interest expense. There's no interest expense on our T accounts, so we make one. And then we say, well, what's the sister account? Well, if we've incurred this interest but we haven't paid it, we owe it. So let's call it interest payable. And we'll debit interest expense, credit interest payable. And there is our adjusting entry for accrued interest expense. To accrue means to accumulate without payment. In number 12, we have this prepaid rent expense. We paid 48,000 euro up front for 2 years' worth of rent, and only 1 month has gone by, but indeed 1 month has gone by. So we're going to take the 48,000 divided by 24 months and times 1 month. We have 2,000, and that's going to be a reduction in the asset, prepaid rent, and it's used up, so that means rent expense. So what account is being talked about? Let's say prepaid rent. Prepaid rent originally had a balance of 48,000. If you go back and look at our T accounts, it now has a balance of 46,000 because 2,000 has been used up. So we credit the prepaid rent for 2,000. In the key word I just said was used up, which means expense. So our journal entry is going to look like this: debit rent expense and credit prepaid rent, to record prepaid rent that has actually been used up. And that's number 12. In number 13, we have something very similar for the insurance expense. So we had this 16,000 euro insurance policy. It's going to last us 16 months. And it was about the 15th of February that we purchased this. So We have 16,000 divided by 16 months is €1,000 a month times 1.5 months. We end up with €1,500 of that prepaid insurance. What account is being talked about? Prepaid insurance. Get the needed balance in that account. It has a debit balance of 16,000, and we need it to be only 14,500 because only 14.5 months remain. So we need to credit it for 1,500, or to record the reduction in the asset. And that asset reduction also reduces what the owner's share of those assets through the expense. So that's going to be recorded in the general journal like this: a debit to insurance expense and a credit to prepaid insurance, to record the prepaid insurance that's been used up. Okay, that takes us down to income taxes. So income taxes, for book purposes, we record income tax expense on the basis of pre-tax book income. These are general rules, maybe a bit simplified, but we're going to record that expense based upon the pre-tax book income. And let's calculate that. We can go down here. We know we have sales and we have all of these expenses. Actually, we only had cost of goods sold, and we would have overestimated our income taxes if we didn't record these expenses that we've actually incurred. But when we record them, our total expenses are $45,220, and our pre-tax income is $19,780. We haven't paid it yet, but we're going to have to pay. And for this purpose, we're assuming we're going to have to pay it with the current tax return. 35% of $19,780, or $6,923. That's going to be the liability. So what account is being talked about? You could say income tax expense, or you could say income taxes payable. Let's say income taxes payable. There is no income tax payable, so we need to create one, and it needs to be credited because it's on the right-hand side of the balance sheet. It needs to be increased. We do that with a credit. And what about that income taxes? Well, that's an expense. That's something that's been used up. We had that. We're going to have this. We're going to have to pay, and it's going to require using up of cash. And we don't care whether we actually pay the cash or not. We still are going to record it now, and we're going to debit income tax expense for $69.23. I'll show you. Just like this: debit income tax expense and credit income tax payable. So then you record you put your explanation in there. Take all the journal entries for the 5 adjusting entries that we just talked about. That is, I think, the prepaid rent, the prepaid insurance, the equipment, the interest on the note, and the income tax expense. Post them into our T accounts, and then do a new trial balance. And when we do that, if you do it right, I think you'll come up with something like this: our new adjusted trial balance. You want to take another look at it, make sure you've got everything in there that you feel really good about, because if not, you're going to have made an error. And you don't want to make errors. We'll talk about that at some other point in time, what the impact of that is. But we're going to go from here, and if we look at it, I think it's probably generally okay. From here, we're going to, number 1, do the income statement. And the income statement for Doodad is going to look like this. Keep in mind that we start out with the name of the company, the name of the financial statement, and a detailed specification of what the date is. And for an income statement, it's a period of time. And you can't just say the period ended. It's got to be the specific period of time. And it really should have the year that's involved here. We have sales minus cost of goods sold equals a middle line that appears on the multi-step income statement called gross profit. We subtract our operating expenses like depreciation, rent, and insurance. That gets us down to something we refer to as operating income. After that, we put our other revenues and expenses, for example, interest income and interest expense for a manufacturing company, not a bank, because that's what they do, but for a manufacturing company. And that'll give us the income before tax, and then income tax expense and net income. And the owners get this $12,857. That goes to owner's equity. It's going to show up in this next slide in the balance sheet. In this balance sheet, this includes the adjusting entries. This balance sheet shows all of our current assets. These are cash and things that are either like cash or will be used up within the coming year or converted to cash, like accounts receivable. Inventory will be used up, ultimately be converted to cash, but it may not be converted this period. The prepaid insurance and the prepaid rent, this is just the portion that's going to be used up within the coming year. The equipment, less the accumulated depreciation, gives us this $34,800. And then we have these other assets, prepaid insurance and prepaid rent, that are beyond a year. So like for the prepaid insurance, remember the balance is $14,500. $12,000 is going to be used up within a year. Another $2,500 is not going to be used up for more than a year. So we classify that as a long-term or other asset, not a long-term asset, but an other asset. We do the same thing with prepaid rent. Over on the right-hand side of the balance sheet, we've got the current liabilities. Those are liabilities, obligations that need to be paid within a year, or the operating cycle. We'll talk about that later, whichever is longer. And we have accounts payable and income taxes payable for total current liabilities of $60,923. And what this is saying here is if you look at the current assets and the current liabilities, is the company looking good, at least based on the snapshot at the end of March 31st to whatever year that is? Does it look good in getting through the next year? And it does. It's got $336,000 in cash and only $61,000 in obligations. Having said that, that's not everywhere you should be looking. You should be looking at the income statement and the statement of cash flows for if this is a really high growth company and they're burning lots of cash. Maybe they're just burning lots of cash. You hope they're high growth in that situation. But you want to sort of estimate how much will they make it through the next year. Then we look at shareholders' equity. This is the part that's paid in. We call it contributed capital. It's part the par value and the additional paid in capital above par, total of $600,000, plus the profits that have been left inside the company since the beginning of that company. That is the sum of all of the net incomes on all of the prior income statements, minus the sum of all of the dividends that have ever been paid by this company, will give you the retained earnings. And we add the current liabilities, the long-term liabilities, that's 86, and the 612 shareholders' equity, and we get liabilities and shareholders' equity. There you have, and so there's the explanation about the net income. We haven't had any dividends paid, so the net income is exactly what the profits were for that. I mean, the retained earnings are exactly what the profits were for that period, and since it's the first period for that company. So that was the doodad example. It was an accounting cycle that it was through the start, recognizing what a transaction is, the accounting equation, the debits and the credits, a trial balance, and talking about adjusting entries and adjusted trial balance, a multi-step income statement, and then finally a classified balance sheet. A couple of caveats: what we did not cover. We did not cover the cash flow statement. It's important, but it is not included. And we didn't cover closing entries. And closing entries are those entries that remove the balances from the revenues and expenses, because they're temporary owner's equity accounts, and puts them, essentially zeroes them out, and puts the net income into retained earnings. It is important because otherwise, if you leave it in there, you're going to be overstating next year's revenues and expenses. And you need to start over with zero balances on the first day of the next period. And you do that with closing entries. There you have the doodad example.